Market is at all-time high. Should you invest now? Hi, this is Piyush and I've been helping people to achieve financial freedom for over 10 years now. So, your family is asking you to break the FD and invest in the market now. Your friends are showing you returns from the stocks they have invested in, which has tripled and quadrupled in only few months. Everybody is talking about the market these days. Markets are touching lifetime high every day. As we speak, Sensex has touched 81,000. You have seen one of the great bull run of our generation. And did you miss the bus? If so, is it the right time to invest in the market? Let's answer these questions. Let's dial back a bit and check the history of our markets. To be concise, last 30 years of our history. Market, specifically the Sensex, was at 4500 around July 1994. Today it has touched 80 to 81,000. Do you know how much return it is? This is exactly 10.3% annualized return, or the CAGR. You were not expecting this, right? You were expecting somewhere between 20 and 30%. So this is our own history of Indian markets. So first point is curb your expectations. Now let's discuss the performance of the market in blocks of 5 years, 7 years or 10 years. In 5 years block starting from 1994, in the first block market is given 0.27% return. In the second block market is given 3% return. In the third block market is given 25% return. In the fourth block market is given 12% return. And now let's talk about fifth and sixth block, where it is given 9% and 15% respectively. So you can see only the first two blocks, which is 10 years, market has not given much return. It has basically given negative real rate of return. That was mainly due to dot-com bubble crash. Post this, market is giving consistent return, but average can be dependent on how the economy is performing. There were 4 7-year blocks in 30-year period. In the first 7-year block, starting from 1994 to 2001, market is given negative 2% return. In the second block, ending in 2008, market has given 21% return. In the third block, market has given 12% return. And in the fourth block, ended in 2022, market has given 9% return. Keep in mind, I'm talking about annualized return. These are not absolute gain. Now let's talk about the 10 years block. So there's only been 3 blocks as we are talking about 30-year period. So the first 10-year block, which is 94 to 2004, market has given only 2% return. So if the inflation was 10%, your real rate of return is actually minus 8%. In the second 10-year block, market has given good return of 17%. And the third, which has ended in July 2024, market has given 12% annualized return. So we have discussed 3 different blocks, 5 years, 7 years and 10 years. You can see some consistency in the data there, that for the first 10 years, or for the first 2 blocks of the 5-year, first 1 block of the 7-year and first 1 block of the 10 years, there was absolutely no return. Post that, you can see some decent return being generated by the market. In these blocks, you have seen multiple crashes. Still, you can see market has performed relatively well in comparison to other assets. Now question comes in today, whether the market is at all-time high, should you invest your hard-earned money or not? Let's check one more point. How much time market takes to recover from the crashes? Let's talk about the dot-com crash. It took 4 to 5 years to break the previous high. It means there was absolutely no return if you had invested at the peak of the dot-com bubble crash. Let's talk about the crash in 2008, subprime mortgage bond. It took almost 6 years to recover from the crash, from the peak. Again, if you would have invested at peak, you would have waited 6 years to get back the price with absolutely no return. The fastest recovery you have seen in our lifetime is actually from the COVID, where market has recovered from the previous high in just 8 months. And now, as you can see, it is making new highs every day. So that was the short history or the summary of our Indian markets. Let's suppose you are waiting on the sideline with the cash in hand and you are waiting for the market to fall so you can invest as soon as it falls. What are you trying to do is called market timing, which is next to impossible for most of the seasoned investors as well. You should look for time in the market, not timing the market. As you can see, market is divided into two parties right now. One are bulls, others are bears. There is high optimism in the market. A lot of money is flowing into the market, especially the equity market. Last month in June, 40,000 crore has entered into the equity mutual fund, of which 50%, more than 50% was in thematic funds only, which is a classic case of bull market. On the other side, some prominent investors are giving cautious signal to the investor that they have to be careful while investing in this market at these crazy valuations. So which side you should be on? Should you still keep investing in the market as you are expecting a great bull run, or you keep the cash with you to invest if the market falls, as most of the people are talking about? As mentioned before, curb your expectations. Somehow you have to limit your expectations, which has been developed to generate extraordinary return in the last few months. So after all this, how do you invest in these kind of markets? You need a strategy, you need asset allocation. Nobody knows where the market is being headed, whether it's going more upwards, whether it will halt and come down. What you need is a strategy with proper asset allocation. In times like this, maybe your asset allocation can be skewed towards debt more, equity less, but you still need some equity in your profile, in your asset allocation. Don't stop your SIPs, keep them running, because they work on a strategy called dollar cost averaging. The market will go high, you will get lesser unit. Market will go low, you will get more units. So ultimately your cost is getting averaged. Book profits from pockets of overvaluation, whether you have invested in a small cap mutual fund or whether you have invested in a particular company which has gone up quite a lot. If you've seen that kind of return, it's wise to book some sort of returns and do some profit booking from there. There are still pockets of undervaluation available in the market. You can do your own research and find those sectors and invest in the same also. Let me conclude this video by saying is India is growing rapidly, as you can see from the news as well. This will reflect in the stock market returns over a good number of years. There might be a crash happening now, tomorrow, day after tomorrow, a year from now, 2 years from now. Nobody knows that. What you need is a strategy. What you need is a proper asset allocation. Don't go in and put all the money in one single asset, whether it's a stock, whether it's a particular mutual fund. You have to diversify. Especially in these times, diversification is the key for risk management. If you have missed this bus, your answer is staggered investing. Spread your investment over a multiple year period. Do your SIPs, check for the undervaluation pocket, invest in those, and follow a strategy. This will save you from a crash and will bring you some sort of risk management in your finances, which is very critical at this point of time. Thank you for watching this video. For more amazing information, like, share, and subscribe. Pranam.